Let me share a fundamental truth about the markets. Countless candlestick patterns emerge across your charts every single day, but do all of them actually deliver results? Absolutely not. Today, I am going to walk you through 7 incredibly powerful candlestick patterns whose accuracy is on a completely different level. Beyond just identifying these structures, we are going to dive deep into the raw human psychology fueling them, giving you a definitive edge to transform your trading results. Let us start with a universal favorite that almost every trader loves, the hammer. The hammer is a stark, high-probability bullish reversal candle. Typically, when this asset prints, the market is preparing to rocket higher. To validate a true hammer, you must look for one ironclad condition. The lower shadow, or wick, must be at least twice the length of the candle's real body. When this exact structure forms right against a key support level, the statistical probability of an explosive upward move skyrockets. Think about a live chart where the price slides down, hits an established support line, and prints a pristine hammer. Right on cue, the market reverses and aggressively builds bullish momentum. But you need to look past the mere shape and ask yourself, what is the hidden mechanism driving this? Why does a hammer force the price upward instead of continuing down? The secret lies entirely within the emotional battlefield of that specific time frame. When the candle first opens, the bears take total control, aggressively driving the price lower to trap early shorts. But as the price plunges into an important support zone, a wave of eager buyers steps up, completely overwhelming the selling pressure and violently shoving the price back up. By the time the session ends, the bulls don't just recover the ground. They successfully force the close above the opening price. The bears threw absolutely everything they had at the market to force a breakdown, but the bulls staged a total takeover. This long lower tail is a monument to buyer dominance. To trade it safely, we simply wait for the very next candle to close completely above the hammer's high. Once that confirmation prints, it proves buyers still retain full control, offering a high probability trigger to go long. Now, let us flip the script and look at a structure that short sellers absolutely live for: the shooting star. This is a deeply bearish candle that typically signals an impending sharp drop in price. Just like its bullish counterpart, it comes with a strict structural requirement. The upper wick must be at least 2 times larger than the actual body. When you spot this pattern forming near a major resistance area, the odds heavily favor a downward collapse. Imagine a market that has been riding a steady uptrend. It experiences a brief pullback, catches its breath, and rallies right into a heavy overhead resistance zone where a clean shooting star prints. Suddenly, the entire upward trajectory stalls, giving way to an intense influx of selling pressure that drags the asset down. Let us dissect the psychology behind this shift. At the opening bell, triumphant buyers push the price higher, making it look like the uptrend is continuing unfettered. But the moment it knocks on the door of that critical resistance, institutional sellers wake up, stepping into the market with immense volume and violently slamming the price back down. The bulls made a massive, highly visible push to break out, but they failed catastrophically. The bears completely commandeered the session, leaving a long upper shadow that visualizes overwhelming distribution. When you see the next confirmation candle close decisively below the low of the shooting star, it is your cue that both sessions are completely saturated with selling pressure, creating an ideal entry point for a short position. Moving past single candle formations, our third high accuracy pattern brings us to a multi-candle phenomenon known as the 3 white soldiers. This is a powerful bullish continuation and reversal pattern built from a specific combination of 3 consecutive candles. The strict criteria require 3 robust, large-bodied green candles with very minimal or non-existent wicks. Critically, each consecutive candle must close higher than the high of the previous candle, painting a picture of uninterrupted strength. When this pattern manifests around a major support level, its directional reliability climbs to the next level. Let me pose a crucial question to test your chart reading eyes. If you see 3 green candles, but the second candle closes below the highest point of the first candle, can you consider this a valid 3 white soldiers pattern? Absolutely not. If that second close fails to breach the previous high, the structural integrity breaks, and you cannot classify it as this pattern. Let us break down the internal mechanics of how these 3 sessions unfold. The first candle opens, and buyers exert absolute force, driving the price up to close near its dead highs. The second candle opens, and without missing a beat, the bulls maintain their dominance, effortlessly driving the price even higher to print another strong close. By the time the third candle opens, the bears are entirely paralyzed. Buyers flood the order book once again, lifting the price further into the close. These three distinct periods showcase an undeniable, sustained flow of capital. Consider a practical example. The market pushes down into a historical zone, bottoms out, and begins to turn. The area where the price previously pivoted and surged becomes our defined support line. As the market retests this zone, it prints a textbook three white soldiers pattern. This is your green light to execute a buy order. To manage risk, place your stop loss slightly beneath the lowest point of this three-candle cluster, and map your profit target directly to the nearest major overhead resistance zone. As the trade unfolds, the momentum effortlessly carries the price forward to smash your target. At this point, let me pause and ask you an important question to test your psychological understanding. Which pattern holds a higher statistical accuracy, the single hammer or the three white soldiers? Take a brief moment to think about it and lock in your answer. If you truly grasp the underlying psychology we just discussed, the answer is obvious. While a hammer shows an intense, concentrated burst of buyer power over a single session, the three white soldiers proves that buyers have maintained absolute control across three distinct intervals of time. Because it demonstrates sustained commitment rather than a temporary reaction, the three white soldiers inherently possesses superior accuracy over a single hammer. Now, as an active trader navigating these intricate structures, a major bottleneck can appear if you are constantly managing multiple technical indicators or tracking 4 different layout views simultaneously. Returning to our high accuracy toolkit, our fifth essential pattern is the mirror image of the soldiers, the three black crows. The visual characteristics are identical in structure but reversed in implication, meaning all 3 consecutive large-bodied candles must be a deep red color. Imagine an asset rallying aggressively into a known ceiling. It leaves a minor pullback trace, setting up a clear horizontal resistance zone. As the price tests this upper boundary, it prints a clean 3 black crows pattern, waving a massive red flag that the trend is reversing. This gives you a highly reliable signal to enter a short position. You place your protective stop loss slightly above the highest wick of the 3 crows and anchor your take profit target to the closest floor of support. Shortly after entering, a violent wave of liquidation triggers, sending the market into a freefall that clears your target with ease. The psychology here is a masterclass in panic and distribution. The first candle opens, and the bears immediately step on the gas, forcing a low close. The next session opens, and instead of finding buyers, sellers double down, driving the price even deeper. By the third session, panic sets in. Long liquidation fuels the fire as the bears crush any remaining support to close near the absolute lows. Across all 3 periods, market participants demonstrate a singular, aggressive desire to exit longs and build shorts, indicating a massive probability of ongoing downside. Next, let us examine an elite 2-candle combination known as the bullish engulfing pattern. This structure requires the first candle to be a small red session, followed immediately by a massive, robust green candle. Because it is a bullish trend reversal signal, it demands to be traded exclusively around valid support areas. The critical rule for validation is that the entire high to low range of that first red candle must be completely swallowed or engulfed by the body of the second green candle. When this forms right at a key support level, the market typically experiences an immediate structural shift. Let us look at the emotional transfer of power happening inside those 2 bars. On day 1, the market opens and sellers drift the price lower, mapping out a standard bearish close that makes the bears feel entirely secure. On day 2, the price actually gaps down slightly at the open, tempting sellers to push even harder. But suddenly the tides turn completely. Institutional buyers step into the market with immense size, completely halting the decline and initiating a massive counter rally. The buying pressure is so intense that it overpowers the entire range of the previous day, forcing a triumphant closeway above the first candle's high. The bears had total control, but within a single session, the bulls completely wiped out their progress and established a new regime. Once the subsequent candle closes above this giant green bar, the entry signal is officially locked in. Naturally, this brings us to its bearish twin, the bearish engulfing pattern. Once this prints, the market almost always prepares for a severe downward slide. Structurally, the first candle must be a green ascending bar, and the second must be a commanding red bar. To maximize your win rate, you must hunt for this pattern exclusively as it tests major overhead resistance lines. Just like before, the entire high and low range of that initial green candle must live entirely within the body of the second red candle. Let us track the price action as it rallies toward an important resistance zone and prints this exact formation. The psychology unfolds in a beautifully deceptive way. The first session opens and buyers easily steer the market higher, achieving a solid green close that breeds retail overconfidence. The next candle opens with a slight gap up, looking like a textbook breakout. Buyers feel invincible, but out of nowhere, massive supply hits the market. Institutional shorts aggressively slam the price down, completely erasing the morning's gains and pushing the market deep into negative territory. By the time the candle closes, it has completely broken below the previous session's low. The bulls had the gap, the trend, and the momentum, yet they were completely decimated by the end of the day. When the next confirmation candle prints a close below this red candle's low, it is your cue to execute a short trade and ride the descending wave. Finally, we arrive at one of the most misunderstood yet critical formations on the chart, the doji. The doji is the ultimate visual representation of pure market indecision. It manifests in various shapes, such as the dragonfly doji, the long-legged doji, or the common doji. But you must avoid overcomplicating these names. Keep your execution simple. At its core, a doji is defined by having virtually no real body at all, accompanied by long shadows stretching out on either side. It is a dual-purpose tool that can trigger both spectacular longs and highly profitable shorts depending entirely on its location. If you spot a doji resting directly on top of a major support zone, do not guess the outcome. Instead, wait patiently for the market to resolve the tension. If the very next candle breaks out and prints a solid close above the doji's high, you have your confirmation to enter a buy order. Conversely, if a doji prints directly against an important overhead resistance line, you stand aside until a bearish confirmation candle slams down and closes completely beneath the doji's low, signaling a high probability short entry. Never jump the gun on a doji. Because it represents a balanced state of indecision, the confirmation candle is your mandatory map. The internal psychology of a doji is a fascinating tug-of-war. The session opens and the bears launch a massive raid, driving the price deep into a trough. But the lower prices attract the bulls, who mount a massive defense and drive the price all the way back up to the highs. Just when it looks like a bullish victory, the bears strike back, pushing the price back down to the center. By the closing bell, the price settles almost exactly where it opened. Both sides fought with maximum capital and maximum aggression, yet neither could secure a single inch of ground. This complete equilibrium is why we call it an indecision candle. It tells you that the old trend is completely exhausted, and the spring is coiled tight for a brand new directional breakout. Master these psychological footprints, protect your capital, and let the market structure pay you exactly what you are worth.